We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Inflation has been dominating the headlines for a few months now, which I find kind of interesting because prior to the pandemic, most headlines were questioning whether or not inflation was too low. But as we're seeing the largest increases in prices in over a decade, some investors are nervous. Now, of course, the future is always uncertain, but as I frequently say, it's the long-term investor's willingness to bear this uncertainty that creates the opportunity for profit. There's always going to be something to worry about, and the possibility of an unwelcome or unexpected event really should be addressed by a portfolio's initial design rather than by some sort of hasty response to the stressful headlines about the future. And as you'll learn in this episode, simply staying invested can help investors outpace inflation over the long term. But before we dive into the data and all the strategies related to investing for inflation, let's level set and explain exactly what inflation is. Inflation is the rate at which currency loses its purchasing power as prices increase over time. So, say a cup of coffee cost $1.20 years ago. If the average annual inflation rate had been 2% between then and now, that same pour would cost you $1.49. Inflation occurs when there's more money circulating than there are goods and services to buy. So think about what happens if you try to attend a sold-out concert or sporting event at the very last minute. There's more demand for tickets than tickets available, which results in higher prices. The most widely quoted inflation measure is Consumer Price Index, or CPI, which tracks price changes from month to month for a basket of goods and services used by the average consumer. So using this measure, inflation has averaged roughly 3% since 1914. And it's this consistent rise in prices that's one of the reasons people are surprised by how much they need to save for retirement. Thanks to the power of compounding, inflation of 3% cuts your purchasing power of your hard-earned savings in half about every 24 years. And that all sounds bad enough, but we've seen even worse inflation in the past. In the 1910s, the U.S. suffered 4 back-to-back years of double-digit inflation toward the end of the decade, the worst being in 1918, when prices rose by an astounding 20.4%. More recently, inflation averaged 7.6% from 1968 to 1981. And it's these periods of hyperinflation that are what are raising concerns among some investors. Especially after several decades of relatively stable prices, the question on some investors' minds is whether the current economic conditions launch us into another period of inflation that runs well above the long-term average. I wrote an article a few months back that I'll link to in the show notes that talked about investing for inflation. Now, the article was written before we saw any of these elevated inflation numbers, but higher inflation seemed inevitable at the time because prices had collapsed in the spring of 2020 when the pandemic had started. So we knew with the economy reopening that the reported year-over-year inflation numbers for the spring and summer of 2021 were going to be pretty high. I'm going to read you a quote here from the article that I wrote back in April. Quote, "Even if inflation, as measured by CPI, rises through May at a rate consistent with 2% annual inflation, it will show a 3.2% year-over-year rise that would be the highest since 2011. This is the kind of data that inspires alarmist clickbait-style headlines that read something like, 'Inflation highest since 2011,' end quote." And sure enough, those are exactly the type of headlines we've seen over the past several months. Most recently, June's CPI was up 5.4% for the year ending in June 2021, which naturally led to headlines drawing attention to it being the largest annual increase since 2008. If these headlines, as well as the real-life price increases you're seeing in your everyday spending, have you concerned about hyperinflation, consider that the economy is still a long way from operating at full capacity. And general economic thinking goes that getting back to fully normal would be the point at which inflation pressures could become problematic. Also remember that inflation is a slow-moving process, and the economy would have to run hot for a very long time to push inflation significantly higher. We're already seeing signs of the economic momentum slowing, but if we think back to the most recent period of double-digit inflation in the late 1970s, it didn't just happen overnight. It took a series of events, from the guns and butter spending of the Vietnam War and Lyndon Johnson's Great Society program to kick things off. Then the Nixon administration continued to run the economy hot with wage and price controls. And after that came two big oil price shocks. But the following period of high inflation showed us that the Fed has the ability and willingness and the tools at their disposal to curb high inflation. And in my opinion, I don't think there's any reason to think they wouldn't do the same today if it got to that point. Of course, inflation, like many other things in financial markets, is a mix of calculus and psychology. The psychology involved with inflation expectations is important because when people are accustomed to low inflation, it takes a lot to change those expectations. Now, consider that we've had almost no volatility in inflation over the last 30 years, and since 2007, there's been more concern about inflation even being capable of reaching the Fed's long-term inflation target of 2%. In my opinion, both workers and businesses are going to need to see inflation remain elevated for a prolonged period, not just a few months or quarters, before they start expecting higher wages and charge higher prices, thus setting off the self-enforcing upward spiral that we know of as inflation. So again, let's put some of these recently rising inflation numbers into context, even if it means I end up repeating myself a little bit. First, recent inflation readings are comparing prices from the spring and summer of 2020, when we were still deep in this really unusual pandemic economy, to the summer and spring of 2021, where the economy is broadly reopened. Second, don't forget that inflation's not all bad. In fact, it usually goes hand in hand with economic growth. Now, the initial stages of this economic recovery have been a bit stronger than expected, and some of that has contributed to the higher inflation. But many of the forces driving certain prices higher, and in turn inflation higher, those are starting to wane. And that's why the market's starting to price in future inflation in the 2% rather than the 3s. But even if inflation was in the 3s, that's still not all that high. I mean, it's certainly a far cry from hyperinflation, and some inflation is going to be more desirable than deflation, which to me would be much, much worse for the economy and for portfolios. For most of the time since the financial crisis, policymakers have been fighting off deflationary forces and struggling to meet these really modest long-term inflation targets. And for what it's worth, historically speaking, short bursts of high inflation have had a much lower impact on purchasing power than sustained periods of high inflation. So in short, both markets and policymakers have been projecting this most recent spike in inflation to be short-lived, and I think that can be viewed as a positive. But what if the market's wrong and inflation gets out of hand and stays that way for a while? So I think that's the concern that people have, and depending on who you speak to, the possibility of such a thing happening ranges from unexpected to possible to near certainty. And this is backed by pretty robust academic evidence, is that even the best explanatory models rarely serve as effective predictive models. For example, scientists can readily explain why earthquakes occur, but our ability to forecast times, locations, and severities remains shaky at best. The same can be said for inflation. We can explain its intricacies, but accurate predictions remain as elusive as ever. There's simply too many variables, whether it's COVID-19, climate change, political action, the Federal Reserve, other central banks, consumer banks, lenders, borrowers, employers, producers, employees, investors, global currency, the dollar, cryptocurrency, the media, the world, time, you. All of these things can throw off predictions about the time, degree, and extent of future inflation. Besides, as an investor, you really only have control over the last thing I mentioned, which is you. That, and of course, your time in the market. And because we don't know the future, we diversify. It stands to reason that some investments seem to shine when inflation's on the rise. Others deliver their best results at other times. Because we never know exactly when inflation might rise or fall, an investor's best course is to diversify into and across various investments that tend to respond differently under different economic conditions. And if you've never done it before, it's definitely time to define your financial goals and build your personalized, globally diversified portfolio to complement them. Now, if you've already completed these steps, you should already be positioned as best as you can to manage higher inflation over time, which means your next best step is most likely to stay put. Which brings me to my next point. In the long run, stocks are the best hedge against inflation. Historically, average global equity returns are nearly 7% more than the rate of inflation. And a big reason that stocks beat inflation over time is that corporate earnings and dividends tend to grow faster than inflation. Going back to 1928, both U.S. dividends and earnings have grown roughly 5% a year, while inflation has averaged about 3% a year. And it's true, stocks have historically experienced below average returns during periods of higher inflation, but ultimately corporations pass on higher prices, the wages and the input costs, to consumers, which in turn boosts revenue and earnings in the long run. It's also important to add that no fancy market timing moves are required or desired when participating in the stock market. In fact, moving holdings in and out at seemingly opportune times is more likely to detract from the vital inflation-busting role that stocks play in your portfolio. And to borrow a recent quote from Nobel laureate Eugene Fama, quote, "The nature of the stock market is you get a lot of return in a very short period of time. So you basically don't want to be out for short periods of time where you may actually be missing a good part of the return." End quote. Again, stock market returns have historically experienced below average returns when inflation is rising, but it's not the doom and gloom that you'd expect. I have some data from an article written by Ben Carlson, which I'll link to in the show notes. Since 1928, the average annual return for years in which the inflation rate is rising, the S&P 500 had an average annual return of 6.7%, while the average annual return when inflation is falling was nearly 17%. And since 1928, the average annual inflation rate in the United States is right around 3%. But when inflation has been above 3%, the S&P 500 has returned an average of 6.3% compared to the average annual return of 15.7% when inflation is less than 3%. Now, right now, market expectations for inflation over the next 5 to 10 years, it had spiked in the spring, but it has since fallen back into the 2% range, which suggests that the market sees most of the pricing pressure easing as the supply and demand imbalances throughout the economy work themselves out. But what if higher inflation persists longer than expected? Again, back to this question, we know that stocks are the best bet for beating inflation in the long term, but short duration bonds and even cash are the best bet to combat inflation in the near term. The same article from Ben Carlson that I just mentioned outlines the performance of stocks versus short duration bonds and cash. And what you see is that short duration bonds perform well in periods of inflation. And that's probably because higher inflation leads to increases in interest rates. And rising interest rates are a good thing for bonds if you can reinvest the interest and principal payment at the higher rates. And when you have a shorter duration bond, you typically get your principal value back. And that means that you get to reinvest more quickly at these higher rates and thus benefit from the higher rates more quickly than, say, long duration bonds. And although rising rates result in immediate bond price declines, the impact is relatively muted for short-term bonds since their prices are less sensitive to interest rate fluctuations in the first place. And unlike other inflation hedges, short duration bonds, and again cash, experience far less volatility. One of these other inflation hedges, for example, that has a little bit more volatility are Treasury Inflation Protected Securities, or TIPS. TIPS are bonds issued by the U.S. Treasury in which the principal value rises and falls with changes in the consumer price index. And the coupon payment on TIPS is also continually recalculated off this adjusted principal amount. The problem with TIPS is that current expected inflation is already baked into prices and yields. So that means you only win if inflation is higher than what the market expects. So if the market's expecting inflation of 2.5% over the next 10 years, if inflation's higher, TIPS will pay off. If it's lower, they won't. So to me, using TIPS this way is more of an active bet that you're smarter than the overall bond market. And remember, the bond market's driven by massive institutional traders that collectively know more than any one person possibly could. And it incorporates the doom and gloom views, the overly optimistic views, and everything in between. Perhaps a better route would be to utilize a strategy that buys short duration corporate bonds while using CPI swaps to protect against price rises. And there are funds out there that offer this type of exposure, which I personally find a little bit intriguing. And fair warning, this is a touch more complicated, so I won't spend more than just a minute on it. But CPI swaps are a type of derivative that involves paying a counterparty a sum that's linked to the current expectation for inflations in return for receiving an amount of money that depends on what inflation actually is at a given maturity. This sort of strategy involves more credit risk, but it offers higher expected return than tips-only strategies and also allows for a lot more diversification. Now, tactically speaking, when you're talking about hedges, I think as I had mentioned earlier, you want to build a portfolio in advance that doesn't require you to react. And a lot of times when people are reacting to their fears about higher than expected inflation, they talk about gold or commodities. And I think tactically investing in any of these assets as a hedge is just a form of market timing, something I think we all know conclusively doesn't work. And even so, I don't think that these things are good inflation hedges to begin with. Gold, for example, has been an awful inflation hedge since gold futures began trading in 1975, in part because they tend to rise in anticipation of inflation, rightly or wrongly, rather than with inflation. That probably explains why there isn't a strong correlation, which is stats speak for the relationship between two or more variables, between gold and inflation. Perhaps even worse is that gold is super volatile, which makes it a poor hedge for something like inflation that's relatively stable. Extreme volatility creates a similar set of problems for using a broad basket of commodities to hedge inflation. Now, there's also Bitcoin and cryptocurrency that's coming up as another sort of asset that people talk about as an inflation hedge. And there's several prominent theories that lay out the case for owning Bitcoin, but the closest one to an inflation hedge is that Bitcoin is a form of digital gold. But if we've already established that gold isn't the best inflation hedge to begin with, I'd argue that the merits for using Bitcoin or any cryptocurrency as an explicit inflation hedge share some of the same weaknesses. Again, hedging a very low volatility risk, such as inflation, with a very high volatility asset like cryptocurrency or commodities of any kind, that, by the way, all these come with a litany of non-inflation related risks, it just doesn't make a lot of sense to me. So to wrap up this conversation on inflation, I'll share one last broad idea, and arguably it might be the most important one thus far. Prices and yields on assets already embed the market's expectation for inflation. So inflation concerns are really about the negative impact of unexpected inflation on the real value of your invested wealth. Making moves in your portfolio to outguess financial markets on the outlook of inflation is a relatively futile exercise. You'd be much better off focusing on how to outpace the harmful effects on inflation on your future spending. And nobody has a crystal ball, but fortunately, we don't need a crystal ball to address inflation in portfolios. The data overwhelmingly suggests that simply staying invested helps outpace inflation over the long term. The primary goal of investing is to grow your assets at a rate greater than inflation without taking undue risk. That hasn't changed. If you still feel concerned and wonder what to do with your investment portfolio in the face of potential inflation, you could try a number of these tactical bets. But as I've just outlined, these don't always provide the solutions investors really want. It's also worth repeating that the current data suggests that the risk of runaway inflation is pretty low. So I maintain that the best option out there for beating inflation in the long term and the near term remains a mix of stocks, bonds, and cash. Stocks are easily the best long-term position to hedge inflation, even if somebody might expect below average returns in the years in which above average inflation is occurring, while short duration bonds and cash have historically done pretty well in the near term during inflationary periods. Jumping into a listener question, I'm actually pulling this from my newsletter. I get questions all the time from newsletter readers, and you can go to peterlazaroff.com or thelongterminvestor.com to sign up for my email newsletter. It comes out twice a month. This reader writes, as an investor who was around in the 1970s, I remember what it was like to experience red-hot inflation, but at least you could squeeze a decent yield out of a bond portfolio. Given the low interest rates and growing inflation, where would you look to enhance the bond portion of your portfolio? So the double-digit yields that sound so great completely ignore the impact of inflation. Most of the real returns on those double-digit yielding CDs or treasury bonds that people talk about had low single-digit real returns. Real returns take that nominal return and subtract out inflation. But look, there's no avoiding it. Historically, bond returns have had a real rate of return of about 1%. And so while today there's no avoiding the fact that lower interest rates have reduced expected bond returns, I do think that hoping for the double-digit yields would come with a lot of things that you might not like. In bonds with these very low interest rates, they still play an extremely important role in the portfolio. In fact, portfolio theory always looked to bonds as a source of a volatility ballast. And the stock portion of your portfolio is very volatile. The bonds are there to reduce overall volatility, and that is really the key role that you would own bonds. If you grew up as an investor during this period of a bond bull market, an epic bond bull market at that, it is tempting to think back to when yields were at double-digit levels. But really, you're trying to think of return relative to inflation. And a lot of the reason that bond yields are so low is that inflation expectations are relatively low. And since 2007, as I mentioned earlier, the concern in bond markets was probably more that of deflation than inflation. So I do think that you have to keep in mind that any sort of return forecast can change in response to the evolving assessments of economic and market conditions, but that doesn't necessarily mean your investment plan needs to change. In fact, I think that if you're going to be reaching for yield in your bond portfolio, you're likely to take on more risk than what really makes sense. If bonds are supposed to be the safe part of the portfolio and equities or stocks are what are supposed to grow the portfolio, the amount of return you get from taking more risk in the equity portion of your portfolio is far more attractive than the amount of additional return you take for the added risk in your bond portfolio. So in general, it is tough earning low yields. If you're living off of income, you might consider a total return approach. A lot of research shows that whether you're spending $1 of appreciation versus $1 of income, it shouldn't really matter to you. And so if you take a total return approach, then you can go back to focusing on your asset allocation and let that stock bond split be what really drives how much return you're going to get. For show notes, free resources, and a place to submit questions, please visit thelongterminvestor.com. If you enjoy the show, you can subscribe wherever you listen to podcasts, and please leave me a review. I read every single one, and I really appreciate you taking the time to let me know what you think. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.